Welcome back. It's not the economy that we're discussing today. We are discussing markets, but from a top-down perspective. The Q4 result season is finally done. And today we are analysing what were the key highlights from the numbers and what do we take forward to FY23. First up, the big news, FY22 was a huge high in terms of EPS growth. EPS growth came in at 35%. This is the highest since the Nifty as an index came into existence. That's big, of course, helped by a low base, but big. But do we moderate in the current year and by how much? Also, let's just take the fourth quarter. In the fourth quarter, Nifty companies were slightly below expectations. Sales of Nifty companies grew by 23% versus Motilal Oswal's expectation of 28%. EBITDA was up 18%. Estimates were 19%, clearly indicating that there was pressure on margins. So, where do we go from here? I have with me Gautam Duggad, Head of Research, Institutional Equities at Motilal Oswal Financial Services. By any reckoning, a master of the numbers. Thank you very much, Gautam, for joining me. Well, first up, let's celebrate this 35% growth in the FY22 EPS. Which stocks or sectors shouldered the rally?
Hi, Lata. Good morning, and thanks for your kind words. So in a very adverse and volatile kind of a macro, nowadays good news are very rare.
Yes.
So this is a sort of a silver lining, I would say, because the corporate earnings, not just this year, even last year, were quite resilient. And as you pointed out, 35% full year EPS growth is the highest since FY04. So what basically contributed not just to FY22, but also to the fourth quarter numbers were three sectors, which is commodities and financials, which includes basically metals, oil and gas, and BFSI. So these three sectors put together almost accounted for 83-84% of the incremental earnings that we have seen between FY22 versus FY21. And if you were to add IT, it essentially makes 90%. And the picture was the same for 4Q as well, where we have seen a 21% Nifty earnings growth led by these three sectors. In fact, if you were to remove these three sectors, the growth is a bit more modest at about 10%, which itself was in line with expectations though. But yeah, I mean, the contribution of these three sectors, not just for FY22 or 21, but even between FY20 to 22, because now if we compare pre-pandemic to the normalized scenario, the two-year earnings are up 76-77% for Nifty. And these three sectors, you know, were the heavy lifters.
Yeah.
They accounted for large part of the incremental earnings, and rest of the 10 or 12 sectors pretty much did nothing.
Okay. Let's start with these sectors itself then, banking, metals and commodities. Do you expect this current year also to be as good for these sectors?
So, Lala, the drivers of the earnings for next year are shifting as per our estimates. So, metals, which did exceedingly well between FY20 to 22 and has had a 6x increase in earnings, we are now estimating a 25 to 30% earnings decline. Oil and gas should continue to do well thanks to the crude oil prices and big improvement in Reliance. But you should also appreciate the fact that the ability to predict earnings for some of these sectors is very limited and is vulnerable to the underlying commodity prices. So these numbers will keep changing, right? So the visibility is pretty low. It will depend upon where the commodity prices ultimately settle. What is looking stable and steady and has been so for last 4 or 5 years is BFSI, which is banking and financials.
Okay, fair
this
enough.
year we did.
Go ahead, please.
Profits. Yeah. So next year also we are expecting about 25-26% growth in financials profit. In fact, I mean, as I keep saying, whenever we have met, the profits of financials in Nifty has gone up by 4x. If you look at the bottom of FY18 when credit cost peaked, the profits in Nifty for financial companies was 45,000 crores, which ended FY22 at 1.5 trillion rupees now. So from 45,000 to 1,50,000. And our next year's expectations are showing 1,90,000 crores. So that's about a 25% growth. And then the new drivers are coming in for FY23, which is auto, which has had a terrible last 5 years in terms of underlying earnings performance and also the stock price performance over a longer period of time. So that is where we are seeing some improvement on a low base. And we are actually estimating a profit which should be, replicating FY18 profits now after 5 years.
Oh, okay. I think FY18 was a high that the auto companies have not been able to overcome, even in terms of monthly sales. No matter how much better they have done in May year-on-year terms, they are nowhere reaching the 2018 highs. But okay, I wanted to ask you some more macro questions. But first, let's stick with autos itself. We have seen a stupendous performance in the May sales of commercial vehicles. Not to say that personal vehicles didn't do well. I mean, Maruti also has done well compared to previous several months. But commercial vehicles are just up and away, especially if you look at Ashok Leyland sales. We normally think of a 3-year cycle for commercial vehicles. So is that horse going to run this year as well?
Yeah, that's what our expectations are, that PV has by and large met expectations. However, we should not compare on a YOY basis because May 21 was quite depressed. We were in the midst of the second wave then. You have to look at some of these numbers on a month-on-month basis. So point is, CV is looking quite strong, and which is where we have Leyland in our model portfolio and is part of our top idea. Passenger vehicles growth is meeting expectations. What is the pain point is this two-wheeler and entry level, because rural sales seems to be struggling, and the cost of ownership of some of these entry level two-wheelers has gone up significantly in the last 3-4 years for a variety of reasons. And you've also seen the reflection in their underlying stock price performance for the last 4-5 years. The cycle has lasted, down cycle has lasted far longer than if you look at any evidence in the past. So it's been 5 years of downturn now, and still the monthly numbers are not giving you a very pretty picture. What is working in their favor, however, is the valuations, which are absolutely depressed. And also the fact that incrementally the commodity cost, thanks to some of the interventions by the government, are showing some sign of relief. And then, of course, depending on how the supply situation eases on semiconductor front, you would see numbers progressing forward. Most of the companies are saying 2H FY23 is when they see improvement in semiconductor supply, but we'll wait and see how this pans out. As of now, valuation seems to be the only factor which is working in favor of automobiles.
Oh, only valuation. Would you bet on this horse? I mean, is it in your buy list?
We are very selective there. As I said, CV is something which we like, and then one or two, four-wheelers is where our preference is, specifically M&M and Maruti. But the point is, this is a sector which can surprise if there is even an iota of improvement in demand and supply, given that it is coming out of 5 years of underperformance. If you look at the prices, I remember when we removed Maruti from our model portfolio 2 years back, the price was somewhere about 7,200 and Nifty was 10,000. Today, Nifty is 16,000. Maruti's, I don't know where the price is.
7,900. Yeah, it's not gone anywhere.
Yeah. So there is a huge pent-up underperformance which has happened there. So that can come back if you see improvement in numbers. In fact, after 14-15 quarters of earnings downgrade, we have seen finally a quarter of upgrades in auto. In fact, auto is the best performer this quarter in terms of underlying earnings versus expectations. Okay,
with one more macro question and then I'll come back to sectoral. You have pointed out that there is a 210 basis point suppression of margins in the Nifty in the quarter gone by. Because of raw material prices. Will that also dog the current year lower margins and hence, EBITDA not growing as well as top line?
So definitely 1Q FY23 is looking quite challenging because the entire, pressure of input cost inflation has not been yet felt in 4Q numbers because a lot of companies were sitting on low cost inventories of Jan and Feb. So 1Q FY23 has two challenges: the spillover impact of input cost inflation, and second, also a very challenging base. In fact, June 21 at the highest underlying growth. Nifty earnings were up 100% in June 21, and our broader coverage universe earnings were up 120%. So you will see June 2022 corporate earnings very modest compared to what we have seen in March and December for the previous 2 quarters. And then subsequently, depending on where the input cost bogey settles, the earnings will progress. But must say that from this point of time, it looks like there is a clear downside risk to the earnings, whether you look at Nifty or a broader market.
Oh, really? Your 18% EPS growth forecast at the moment, you think has a downward bias?
Absolutely.
Oh, okay. Okay, automobiles is something that you would bet on at this point in time, at least some of them. And then you said banking, which is the other big sector of FY23.
So for last 2 years, we've had a very sanguine view on IT. It's our single largest overweight still in the model portfolio, of course, with a very clear bias towards large caps. So we have about 18% weight in IT in our model portfolio, out of which 17% is allocated towards the large cap. And that is a sector where I still find a lot of value given the recent correction that has happened. And the demand commentary hasn't changed at all, whether it is for large caps or mid caps. The problem, however, is the valuations of mid caps are very frothy even now after the recent correction. Large cap offers 2-3 points of comfort. The demand is quite stable. They are not seeing any client concentration risk, which is very important in this kind of an environment where macro has turned suddenly adverse and volatile, and people are debating endlessly on the probability of a US recession. Second, the cash flow and underlying free cash flow matrices for large cap IT is extremely strong. And we have seen frequent buybacks happening. In fact, their payout ratios have gone up from the already elevated levels 2 years back. And third, the supply pressures seem to be easing off given the some sort of challenges that we are now seeing in startup ecosystem.
Yes.
So the margin
attrition is down. Yes.
Yeah. So on a 12-month trailing basis, the attrition numbers are already coming down, even though they are elevated. But these companies have a lot of margin levers still at their hand, whether it is the onshore-offshore mix, pyramid rationalization, or even the utilization improvement. So I would think after the recent correction in large cap IT, this does offer some value now.
Okay. We're running out of time, so I have to quickly get in the mid caps. How have they done vis-a-vis the large caps in FY22, and what's the prospect for 23? Would you lean on them at all?
No. So our view and our this has been the case for almost a year now. We are clearly more biased towards large cap because mid cap index is still trading at a premium to large cap Nifty.
Oh.
And in the past, we have seen whenever this happens, this doesn't last for a long time. And in any ways, in an environment where rate hike plus QT is happening simultaneously, mid cap as an index will always be vulnerable. But the peculiar thing about mid cap always is there will always be 10, 15 bottom up ideas that you can always find to invest into. Okay. But from an index point of view, I would still remain very, very cautious on mid caps.
At least leave us with some mid caps, Gautam, which is in your portfolio.
So yes, we like QSR as a space. So there we like Jubilant, we like QSR. We just spoke about Ashok Leyland. In the financial space, we like Chola, we like AU Finance, we like Crompton Consumer, given that the valuations are looking quite juicy now. So, and then of course, there are, in real estate, we like Lodha. Overall, the bias, however, still is predominantly in favor of large caps, given the relative valuation relative attractiveness of the valuation for large cap versus mid cap and small cap. I think mid cap valuations still need to correct, whether time correct or price correction, before one tends to have a positive view on the mid caps.
Okay. Well, we will have to leave it at that, because if I start a question now, I will go over on Bazaar. It's an absolute pleasure speaking with you. Thank you very much, Gautam, for giving us a quick wrap of the Q4 numbers. The big story is that FY22 has been a huge year for earnings growth, largely because of a terrible base in FY21, 35% growth. But for the current year, and markets are forward-looking creatures, the expectation is half of that, 18% growth with, as you heard from Gautam, a downward bias. So a bit of a warning over there, but then the markets have come back to somewhat fair valuation terrain or their last 10-year valuation terrain. So we will have to wait and see whether it's earnings or valuation that help us propel forward. At the moment, the markets are really in no man's land, neither with the bears nor with the bulls. A slight tinge of green is all I can say. And advanced declines are clearly in favor of the advances, nearly 2 in the green for 1 in the red. Let's see how the day goes, and it is also an expiry day, so perhaps lots of game left. We wrap up on Bazaar, trading ideas on Chart Pass.